Kia ora! Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Frances Cook. I'm the investments editor at BusinessDesk. Now, we have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch100, you'll get $100 off an annual subscription to BusinessDesk, which is usually $249, including GST. The offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts. Also, it's important to remember investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. You should review relevant product disclosure documents before deciding to invest. Now, today on Shared Lunch, much has been said about the headwinds we face in 2023, and now we're here. So what do retail investors need to know about the economy and the political and business environment? We've got a fantastic panel of experts to tell us everything you need to know. ANZ Chief Economist Sharon Zollner, BusinessDesk Managing Editor Pattrick Smellie, and Sharesies 3EO Leighton Roberts. Welcome, everyone. Now, obviously, 2022 left us in recovery mode from COVID. There are now challenges facing China. There's a war, constant ups and downs in the markets, inflation, rising interest rates, and it seems inevitable at this point, recession. So, Sharon, let's start with you, because ANZ put out a really interesting data release December 16th, forecast the economy entering recession in the second quarter of 2023. Now, economic activity expected to decline 1.3% between that period and the first quarter of 2024. So is that still what you're thinking, or do you have any new insights you can tell us about?
Well, we don't update our GDP forecasts in real time, but we certainly do monitor the data flow continually. The main data we've had since then was actually this morning, the quarterly survey of business opinion from the Institute of Economic Research. Now, the main theme was collapsing confidence. That was quite expected insofar as our own business outlook survey was around the same time. So we'll wait and see whether that was just a one-off jolt to confidence that will dissipate, or whether the economy is actually going off at least a ledge, if not a cliff. Certainly, though, that Reserve Bank monetary policy statement in November, with the really aggressive interest rate increase, plus the governor admitting that he was deliberately engineering a recession and telling people to cool their jets, that certainly does seem to have had some shock value, as shown in these business surveys. But what that survey also showed was still very, very persistent inflation pressures. In fact, pricing intentions, cost expectations actually rising again, which is the last thing the Reserve Bank wants to see. So, of course, that combination of weakening activity data but stubborn inflation data is a very difficult one. So what that does tell you is that judgment is certainly going to play a large part in the Reserve Bank's decision as they try and weigh up those opposing forces.
Well, exactly. When we've got these forces coming together and really hammering the economy together, I mean, what are the main drivers there that are causing this to happen, and do we have much control over them?
Well, there's a lot going on. Of course, the Reserve Bank of New Zealand has the control over interest rates, and that is a tool that they've been using in fact, more aggressively than ever. But it does take time to come through the economy. So there's a ferocious debate at the moment about how much more the Reserve Bank needs to do, or whether, in fact, they've done too much, because around half of mortgages are going to reprice over the next 12 months onto significantly higher rates. The average mortgage rate people are paying at the moment is still under 4 or around 4, whereas the rates you can get today are an awful lot higher than that. So it's going to keep increasing. So that's one big factor. Other things we really don't have much control over, like our commodity prices. The fact that China is now reopening in a hurry, it's going to cause some short-term chaos, clearly. We've been there, done that. So supply chain pandemonium. But once that's out of the way, the fact that China's re-engaging with the world is a positive for New Zealand, for our exporters, for our foreign student market. The fact that their restaurants will be open again is great for our meat exporters. That's a good news story. However, if we do see more broad spread commodity price inflation later in the year as China really, it's pretty clear they're really focusing in on boosting growth again. We could unfortunately see that goods price inflation, which has been coming off and providing a really helpful offset to the high wage inflation and services inflation that lots of economies are struggling with, we could see that stall or potentially even go into reverse. So that is still sitting out there as a risk that could mean that interest rates actually not only can't be cut, but could need to keep going higher even as economies struggle under the weight of the hikes already delivered. So there's certainly a very wide range of possible outcomes when it comes to both economic growth and the outlook for interest rates.
Yeah, and as you've mentioned there, I mean, interest rates are a huge factor in the economy, and I feel like many of us have had a real-time lesson in just how wide-ranging the impacts of interest rates can be. So as we've got the Reserve Bank meeting in February to look at interest rates, there's a lot of chat that they could be going up again, possibly up significantly. What are you picking will happen? And do we think it will keep inflation in check, whatever they go for?
So in November, the Reserve Bank just leapfrogged everyone in terms of hawkishness. I'm not sure if hawks can leapfrog, but they did. So that was part of the shock value. But they certainly sounded very, very clear that they were going to deliver another 75-point hike in February. Of course, they had incentive to sound that certain because that's what pushes up the yield curve and therefore pushes up mortgage rates. So they can deliver more tightening on the day by really shaping those expectations of what they're going to do in the future. But it's one thing to say you're going to keep raising rates aggressively as the economy falls into the recession you are deliberately causing. It's quite another to actually do it. And so the market is not pricing 100% chance that they will follow through. And that is entirely reasonable because there is that uncertainty at the moment about whether the Reserve Bank has actually caused a step change in employment and investment decisions amongst firms and in spending decisions amongst households. So as long as that is the case, then there is, of course, a chance that the Reserve Bank might decide that 50 is more prudent, that they have a luxury of a little bit more time, a little less panic urgency about the level of inflation. But we are still picking 75 at this point, and certainly those inflation indicators in the QSBO did not provide any smoking gun in terms of why they should cool their own jets, as it were, and to deliver a smaller hike.
Pattrick, certainly some of the issues that Sharon has identified there, they're big issues. And you've had more than 35 years reporting, working in New Zealand politics, the commercial sector, and we often hear that right now it's unprecedented times. Is it actually unprecedented times with the amount of factors in the mix at the moment?
I doubt it, actually. If you were to go to the nth degree, you could probably find all times are unprecedented in their own way. It does take me back, though, to the early 1990s, late 1980s, early 1990s, to see people as despondent as they are in the various surveys that we're seeing. And also, if I think about that period, very low growth, very high levels of inflation, that was as close as we got to a period of stagflation. And it seems to me that when you put together all the factors that Sharon just went through, I would say it feels to me anyway, as if there's a net likelihood of a period of stagflation. And the BNZ this morning, for example, came out. They haven't revised their GDP numbers either, but they say that they suggest that there's a negative 3% impulse potentially in the combination of what we can see from the Reserve Bank and what we can see from the NZIER quarterly survey. That could be a sharper, deeper, and yet still inflationary recession than we're expecting. So that all adds up to a pretty negative set of circumstances. And then you chuck in a war in Europe and the unwinding of globalization, and certainly, and also actually the unwinding of cheap money that's been with us since 2008 in the GFC. That is a lot of factors. That's why the great and the good who are turning up to Davos are wringing their hands and talking about everything as being a polycrisis. I think we'll hear a lot this year about polycrises.
So, okay, so two things I want you to, as quickly as you can, define for us. Stagflation, that sends a shiver down the spine of anyone who knows economics, but if you could just tell us why that's so bad. And also polycrisis, that's interesting. Tell us about that too.
Okay, well, stagflation, and maybe Sharon can correct me if I get this wrong, but basically it means no growth or a recession plus inflationary impulses, which means that your inflation is still rising. And so therefore your Reserve Bank is going to keep pushing hard on interest rates so that the brakes coming off and allowing the economy to grow again is delayed until that period of inflation is dealt with, basically. Polycrisis is not something that happens in a pet shop when a parrot gets out. It is it's really saying there's a lot of things, a lot of moving parts in the global environment, which affect one another in ways which are very hard to predict. So none of them are sort of black swans in the sense that we know what they all are, but the way that they might interact is very complicated. Will Ukraine prevail in the spring offensive? Will China actually decide wildly, I suspect they won't, but wildly to attack Taiwan? What does the re-emergence of American protectionism mean for countries like New Zealand, which have been committed to free trade, trade liberalisation, and the capacity to get our stuff across borders over the next 10, 15, 20 years? Lots of new problems. Maybe an environment in which inflation is no longer tamed in the 1% to 3% band, but some sort of new respectable idea comes about that says that slightly higher inflation is okay. So polycrisis is really the interaction of all these big global forces which push against one another. Like it's like being at the beach and watching a rip. You don't really know where the waves are going to be.
That's such a good way to put it. So I love how you make us laugh through telling us that, the world might fall apart. Just crack in a quick dad joke there to make us all feel better.
I do what I can.
But it's so true when there's so many different forces interacting, and big forces, it makes it tricky to predict what comes next. And I think that's the other part, and it's so much uncertainty. When you've got these different forces interacting with each other, it makes it really tricky. I mean, Leighton, what do you make of what's been said so far about the forces that we're facing? Do you have your 2 cents on these situations?
Yeah, lots of sense, probably. Not enough dollars is part of the problem at the moment, I guess. But look, I think when you talk about unprecedented and stuff, I mean, it's super interesting to hear Pat's view of it there. But my generation, it definitely is. Like, particularly if I think about my working life, or I was oblivious to the GFC, to be honest. I was in the army at the time, so you got your pay rise every year or whatever it was, and I remember sort of found out that 2008 happened when it was 2009 and I'd started my finance degree. And I think there's lots of people like that sort of have heard these stories for a while about a very complicated financial time, and probably haven't experienced it. We've since 2000 at least been a very low interest rate environment, reasonably stable inflationary environment for even longer than that. Yes, so I guess my view is that it's like sort of it's what stance you coming at this from, because there's sort of lots of learning there, and it does. In some ways, there's a bit of a return to the books or return to the theory at the moment. Like, the people have been saying this is going to happen, and, all bubbles come to an end, and the economy does work in cycles, and we're seeing that cycle again. And it is a little bit later, and as a result, a little more complicated perhaps than what we might have expected. With regards to outlook and what the Reserve Bank, I mean, one thing we know about Adrian Orr for sure is quite bullish in nature, isn't he? And reacts quickly. And to be honest, as most governors or heads of reserve banks around the world did, and are now responding. So it's not really just to look at New Zealand, what are we doing? It's really look at the world and see how that's playing out. So I do think they'll keep the hard line until they have a lot of confidence that the inflation is going to come under control. I think in our everyday lives, we can see that it's probably doesn't quite feel like that yet. Like, I remember buying my first coffee this year, for example, and realizing, wow, that's changed a lot. And I think while we still see those things happening, then we can expect that it'll remain a little bit hard. All that said, I'm an optimist by nature. I would consider myself to be even reasonably well read, if not well experienced in times like this. And I think broadly, people understand that things are going to be a bit tough. It will impact some people more than others, that's for sure, but confidence tends to be worn even by those who probably don't have such a financial impact from it. And look, I think we'll work our way through it, and at some point we'll be reflecting on it as well. Like, that happened, and then start waiting for the next one. We'll have our economists predicting the next one, and that. So how does that play out time-wise? I don't know, but I sort of feel like over the first 6 months of this year, we're going to have a lot more clarity on the inflation thing, which is the big unknown in particular when thinking about interest rates, which for most of us is the largest impact, particularly homeowners and businesses. So yeah, pretty long-winded there, Francis, but lots of thoughts on what you just said already. And I guess I'd just like to reinforce optimist by nature. I think no economy is going to ultimately settle for zero growth. So just as people are reacting or responding right now to lowering inflation, at some point we'll start to respond in a way that fuels economic growth again. I'm quite sure about that.
I think that's one of the interesting things about it is that particularly for investors, there will come a time when it's time to buy with your ears pinned back. Nobody quite knows when that time is, but if you're sitting there looking at house prices and looking at equities prices, and go with Smellie's glib theorem, which I first invented in I think 2000. When was it? Maybe 1998, the Asian financial crisis. Somebody said, "What's going to happen now?" And I said, "Oh, just give it 4 years." Usually these things resolve in some way. The world's getting bigger. We all have to eat. The world population, I mean. There will be a recovery at some point. It's just a matter of writing this stuff out. If you haven't actually seen a cycle for a while, it can be a bit scary to contemplate. But sometimes, I think we could see, if inflation does start to come back, particularly in the US, could start to see some buying momentum by the middle of the year by investors who are confident enough about what the future looks like to say, well, we're not interested in how things are exactly at this moment. We're interested in how things are going to look in a year's time. And this looks like a bargain now. Now, I'm not suggesting that I know when that time is, but those are the kinds of conditions which investors will be looking for across asset classes.
Yeah, it is absolutely true that we go through these cycles, that the bust is unfortunately part of the system. It's not fun. Often the trick is hanging in there as much as you can, and that's how you get through it. It was so interesting to hear you mention Leighton 2008, because you're right. We've gone through a major crash before, but especially a lot of Sharesies investors, I think, probably were at best at university or just starting their careers. And so probably weren't investing through that time, particularly as we didn't have the micro investing platforms then either. So are we seeing anything yet in terms of what retail investors are doing, how they're responding? Is there a trend in what people are going for and what people are seeing as value?
We've definitely seen some change. The first thing is, one thing but it's definitely true that we haven't seen 2008 level financial crisis for most of Sharesies user base, but we've probably seen a lot more volatility than a lot of generations had, and sort of the K recovery of March 2020, pretty much the whole time that Trump was president. Like there's just been lots of things really that mean the large indexes like the S&P been very volatile, and people have sort of got used to these ups and downs a little bit more, perhaps, like the green 1 minute on your portfolio and down the next day. So what does that mean for how investors are behaving? Largely right now there's an attitude of see it through. So that's coming through in surveys, and that's a little bit different to what probably a couple of years ago, which was buy the dip. And so it means that people aren't really flooding in large deposits. But they are sticking with if they have regular investments set up, they're committing to that. So dollar cost averaging. So what we're seeing on the platform is more people using auto invest, which is super interesting and surprising to us actually. We're also seeing more appetite for funds, largely ETFs, which again, interesting. So more heading into those diversified or more traditional investments like gold coming back again, as opposed to a lot of technology or hype stocks, I suppose, that we'd seen over the last couple of years. And that's not to say people aren't there. Companies like Tesla are still very well supported, despite very large change to their share price. But broadly, people are still depositing slightly smaller amounts than what they were previously, and that could be both confidence and affordability related. But as is always the case and has been for the nearly 6 years that Sharesies has been around, I think the retail investor, and I say this all the time, was constantly underestimated by the market, and they're not the people running for the hills at the moment, lowering stock prices and giving up on that demand. So, I think here for the long game is how I'd describe the majority of the user base at the moment.
It's interesting. Sharon, we've touched on property just a little bit, but I think it's important for us to go into it a bit more because, of course, some people will be homeowners, but others are interested in it for the future, possibly as an investment as well. But New Zealand overall is big on housing and very exposed to the housing market. So almost half New Zealand mortgages expected to refix this year, and that's going to be at much higher rates than they were paying previously. What sort of impact do we think that's going to have?
Yeah, so of course it's easy to forget those with term deposits and savings who are quite happy to see interest rates go higher, even if they're not happy about the higher inflation which is causing it. But as a nation, we are net debtors, so it is money being sucked out of people's pockets on net. So what we've seen in the last year, in fact longer than that, is that people in our consumer confidence survey have been saying, oh yes, no, it's not a good time to buy a major household item. And then spas and boats and cars and motorbikes and bicycles have been flying off the shelves. And it comes down to where interest rates were at and the fact that central banks were saying they were going to stay low for a very long time. So, and also I think it came down to the fact that job security has been very, very high. In the household labour force survey, more than half of people said the chance of them losing their job was negligible to zero. So if you're very confident about your income carrying on, and perhaps you've also had some bigger wage increases than expected, the average hourly earnings are up 8.6% in the last 12 months, then that's going to make you feel more comfortable about taking on debt. But of course, those dynamics are changing on a number of fronts. While the wage growth is still very high, the cost of living is still going up relentlessly, but job security, Reserve Bank is forecasting unemployment to rise at almost the speed it did when the global financial crisis hit. And there's no question they have the ability to cause things to slow on that front. And indeed, job ads and the like are starting to come off now from crazy high levels, but it is looking like that has turned. But the most important thing is, of course, those interest rates. And there is the wealth effect that we shouldn't forget as well. For many people, their house was earning far more than they were in terms of the increase in its net value over a given period. Now house prices are going backwards. They're down 14% on a national average, probably more than that in Auckland. And on our forecast, they're on only a bit over halfway through their fall. And there is a risk that if the unemployment rate does rise more or faster than expected, then you could have more people put in a must-sell situation, and those house price falls could actually accelerate further. It could go off the rails. That is still a risk. But so far, it's been a case of so far so good, and it needs to happen. We absolutely have to get housing affordability to something more reasonable. House prices are just stratospheric. They cannot be justified by any fundamentals. So this steady decline that we've seen without panic is ideal. But no one's covered themselves in glory forecasting house prices in the last couple of years. So take anyone's forecast with a grain of salt, I would say.
Well, do you want to risk covering yourself in no glory? Any thoughts on where they might go in the next few months?
Well, we have the Reserve Bank continuing to raise the OCR quite aggressively until the middle of the year. Now, whether they are actually able to do that or whether things are getting a bit sour by then is a valid question. But on the back of that, we have house prices falling 22%. That's almost falling a third in real terms. So if you take income growth into account, that's down a third. That would take them real house prices down a little bit below where they were before COVID hit. I mean, the COVID run up was exponential. It was completely nutty. But that's that isn't necessarily any kind of flaw. they would have to fall, more like 50% to be back where they were in 2010. In fact, more than 50% in real terms. So we're inching our way out of this corner that we painted ourselves into, but there's still quite a long way to go.
Well, we've got these other really big macroeconomic influences. We've got, obviously our border is now open again, China opening up. When we've got all these other big influences happening, are they overwhelmingly positive or negative? Where do you see it going for New Zealand?
Yeah, it actually, it's the classic on the one hand, on the other, like the China reopening. It's definitely good for our exporters and it's positive for global growth, but it could be really inflationary, which makes central banks raise rates by more, which would possibly more than offset the benefit, for example. That's one thing. Immigration, it's clearly rising very rapidly now. That is positive for labour supply and therefore for probably growth, because pretty much a record high proportion of firms are saying that availability of labour is the number one thing that's constraining their expansion at the moment. On the other hand, it does mean more housing demand and more everything demand. So the net impact on inflation is ambiguous, for example, and could we unwind the progress we're making on improving housing affordability and catching up on our infrastructure deficit, that sort of thing. That's definitely a double-edged sword. There's very few things in this world that are purely good or purely bad, but we did have a very long time where bad economic news was good news for equity investors because it meant central banks would keep their foot flat on the floor. Now we've had a little bit of the flavour of the opposite, where strong economic data is suddenly bad news because it means central banks are going to keep hiking rates more aggressively. So it is actually quite remarkable how monetary policy can turn common sense on its head when you think about it, and actually turn good into bad news and bad news into good news. So there's no question that economic decision making has been distorted by the extreme monetary policy that we've had over the last few years. And now, so the hope is that we can have a reasonably soft landing and inflation will just go away and we can go back to where we were before. But the too good to be true test, which is not a very scientific one, but I find it quite compelling, would suggest that after such a big policy mistake, we're not going to get away that lightly. That decisions have been distorted and we haven't yet found out, in the words of Warren Buffett, who's swimming naked when the tide goes out. And the tide is going out, not just higher interest rates, but also that the world's been awash with liquidity and cash, and central banks are now talking about burning cash rather than printing it. That's a pretty fundamental change as well. Very difficult to quantify the impacts of that, but it is just sitting there as a risk.
Pattrick, I think one of the domestic influences that is going to be huge for New Zealand, the election this year. I mean, what impact is that likely to have from a business and investor perspective? And are there any policies that you're keeping a particular eye on?
I think that's really difficult to judge in the sense that I think the polls are already telling us what the outcome is likely to be. So when I look at this, for example, when the Treasury released the half-year economic and fiscal update just before Christmas, it seemed to me that their date for the low point of the recession that they were then finally forecasting was around about when election day will be. So it's very hard to see how a government, which is already struggling in some respects, keeps its head above water. So maybe the confidence impact of a change of government could be positive. I mean, I don't think it's a huge analytical leap to say that the business community, if such a thing is monolithic, probably prefers a conservative government than the government that they've currently got, and that a number of investor communities, if you like, will look at a national government coming in and say, okay, well, we feel a little bit more like we know what we're getting here, which I actually think they're wrong about, because the one thing about this government is that if faced with a problem, they will centralise it, whereas it's not really quite clear what a national act government would do by comparison. But I think there probably would be some sort of confidence bump from a change. That's the sense that I have. That's not. I'm not giving a political view. That's just how it strikes me. But it does feel to me as if, in the interim, Nothing that the government says, unless they suddenly start doing better in the polls, is actually going to get much traction or actually be listened to terribly much by business people and by investors, because they're going to be thinking, well, these guys are going to be gone soon. So it's a strange sort of no man's land from to the extent to which political leadership has an impact on economic leadership. The only thing I would say is the two things that I'm looking at are, if we believe the numbers in the half-year economic and fiscal update, that whoever is next in government has a ridiculously strong fiscal position. No matter how much people talk about higher interest rates, higher levels of debt, all the debt that we piled on during COVID, by comparison with other OECD countries, the Crown accounts are in ludicrously good shape, and we should actually probably be spending more on our infrastructure deficit, except that it'd be like pushing a marshmallow into a piggy bank. We can't. The constraints in the economy are such that you can't actually spend more than we're currently spending, much more anyway. The other thing I'm really interested in is tax policy. It's now almost 13 years since we last saw an indexation of tax thresholds to income being changed. So as a result of which, people on median incomes now are paying high personal tax rates. That's one of the things that's keeping the book so strong. National is campaigning on doing that indexation. It should be quite a big change, and it's massively overdue, and it's incredibly popular to middle New Zealand, I would think. I guess the question I have is, why couldn't Labour do the same thing and gazump them? Because it needs to be done, and there is clearly the capacity to pay for it. And if the trouble is, it would be inflationary if it did it this year. I guess if I was the Minister of Finance, I'd be saying, could I get away with it if I announced those re-indexations from the 1st of April 2024 to give people, show them the rabbit without creating inflationary pressure now by releasing a whole lot of extra cash into the economy? Sharon may think that's a ridiculous theory, but it's the one I've come up with.
Yeah, no, it is kind of ridiculous that those tax thresholds aren't just indexed. It's a little bit like the US debt ceiling, where they have to, agree to increase their fixed debt limit, and then so it becomes a big political issue every single year. It would be a lot simpler to just index it, because otherwise, as you say, it's a real tax increase by stealth.
And 13 years.
Can't surely do something that makes sense.
It's incredible to me that there hasn't been a bit more uproar about the fact that it's more than a decade since this was changed. I mean, what's the average wage gone, or the average household income gone from over that period? It would have doubled.
Yeah, which is 8.6% just in the last year. So
yeah, and particularly with inflation pushing wage growth as well, it just gets that much more out of kilter.
We're running up on time, but Pattrick, in a recent column, you did have the glorious phrase saying, "Nerves of steel and holding your nerve is what New Zealanders will need for 2023. Stand by that, and what sort of areas do you think we'll be needing to ride out and hold our nerve?
Well, it's really the things we've talked about, isn't it? It's sitting there with a significant mortgage, which is becoming more expensive to service while your house becomes less valuable. It's unhappy. It's holding your nerve if the industry that you're in doesn't look as if it is necessarily going to be well treated by the recession. I mean, there are some areas of the economy that will actually thrive in the recession, but there are not that many of them. And I guess as an investor, you could take my approach, which is basically not to look at your portfolio at all, any more than about once every 3 months, and just have a hanky nearby. And have some faith in the likelihood that the human race will work out a way to get out of this. And, maybe these managed funds that I've got money in will be doing clever things and buying when things are cheap.
I know, I always try to remind myself it's happened before and it will happen again, and I'm not special. But it is hard sometimes in the moment to remind oneself of such things. Sharon, let's finish with you on hopefully a positive note. I mean, are there bright spots in all of this? Are there things people should be looking at for a ray of hope and ways of tackling these stressful factors in the year ahead?
Yeah, well, as it was alluded to earlier, New Zealand does have quite a lot going for it. We sell food and people have got to eat. Certainly the value of that as your economic backbone came clear in 2008, whereas if your economy was selling expensive cars, your exports just stopped, for example. So that's one plus. Another one is that we've got a plain vanilla banking system. There's a lot of concern out there at the moment about the shadow banking sector and hidden debt and hidden leverage and hidden derivatives, and we're just just not part of that. And so we shouldn't have those sorts of problems if they do emerge down the track as liquidity dries up. Of course, these aren't so much positives as less negatives, but we did come out of 2008 eventually in okay shape, and recessions, they are unpleasant, but they are necessary to some extent. They do tend to fix structural imbalances, and we've got a couple of and one is debt levels, but although household debt is not as high as you might think relative to incomes, given incomes have grown so much, but our current account deficit is blown out to around 8% of GDP, which is about as bad as it gets. And what that shows is that we've been living beyond our means for quite a few years and not paying our way in the world. You can do that for a while, but at the end of the day, we do rely on the rest of the world to finance us, and so we do need to cool our jets, to channel Adrian Orr's words there. It's not fun, but you can't avoid recessions completely, and the longer you try and put them off, the deeper they tend to be, because those imbalances are allowed to get bigger. So we are in much better shape than many. I would say our biggest vulnerability is the level of house prices and how much fresh air is still under them if things really turned to custard. But I would say our risks are I would say there's plenty of markets and countries where that is not necessarily the case. And so I wouldn't say we're the Switzerland of the South Pacific, but I would say that we might be seen potentially as something of a safe haven in terms of having, a pretty sane political system and pretty sane politicians on both sides of the spectrum, and reasonably predictable policy, and as I said, the plain vanilla banking system, and well understood risks. The risks are there, but what investors really hate is unknowns, and we could have a few of those pop up this year.
Interesting stuff. Well, thank you all so much for your time. That was great stuff. Thanks for listening to this special podcast episode, and a big thank you to Sharon Zollner, Pattrick Smellie and Leighton Roberts for being our panel. We'll be back in February with the Shared Lunch podcast and an exciting lineup of guests for 2023, so stay tuned. If you're not following the podcast, you can on Apple or Spotify or wherever you get your podcasts. Leave us a rating and a comment with who and what you'd like to hear about. Until next time, enjoy the rest of your week. Stay safe.